over the next 30 or 40 minutes, I'm going to talk a little bit about Mpac. Will is going to take us through the 2024 numbers, and then I'll talk a little bit about our ambition for the future, the outlook for 2025, and the progress that we're making on our strategy. But perhaps just to set the scene, let me describe 2024 to you. It really was a transformational year for Mpac. Firstly, we broke through £10 million underlying profit before tax for the first time, actually £10.6 million last year, 49% up on the prior year, and that's actually triple where we were the year before that. Operating margins improved 3 percentage points to 9.8%. Just shy of the 10% target we set for our kind of longer term plan. We almost got there in 2024. We restructured the leadership team around the 5 pillars of our strategy. The strategy's been stable for a long time, and now our leadership team reflects that strategy right from the very top. And we made 3 acquisitions during the year that significantly advanced our growth objective. We actually brought forward our 5-year plan, which was to double the revenue of the business over 5 years. We brought forward that by 2 years, and we're on track to complete that in 3. And that was made possible by a significantly oversubscribed equity raise and new banking facilities. And then finally, last year, after many years, we have seen the defined benefit UK pension scheme go into a surplus. So 5 significant events of 2024. So that transformation of the group means that the shape of the group today is significantly different from this time last year. I'm going to start by thinking about the market. In the top right-hand corner of this chart, you can see our focus on the food and beverage, healthcare sectors within FMCG. Actually, our share of market, our focus on market hasn't changed, broadly the same. But if you were to look at the same data by region, you would see a significant difference today on a pro forma basis from this time last year. In previous years, 45–50% of our group has been focused on sales into the US market. With the acquisitions that we've made last year, particularly CSi, who have strong sales in Europe and South America, actually our exposure to the US market is significantly reduced now, down to about probably 25–30% of group revenue going forwards. The installed base of machines in service, you can see on the bottom right-hand part of this chart. Previous years, you've seen that number hovering around 4,000 machines in service. Now with the acquisitions, the installed base is up to 6,500 machines. So a substantial increase in our opportunity to go and support machines in the service part of our business. And our footprint's changed as well. A year ago, we were a group of around 600 people. Today, 1,100 people, of whom about half are engineers and designers. And we operate from 8 facilities around the world, including 3 in North America, and with some substantial footprints in the UK and Europe too. 6 businesses today, with a much larger capability to offer to our customers, including robotic handling and conveying, automation of the way that products are assembled, secondary packaging, and end-of-line palletizing. So what does that mean in practice? Well, for example, if you're looking at assembling lasagna on a meal line, we produce the machines that actually fundamentally assemble that raw lasagna product. Our machines right now today are assembling disposable razor blade cartridges. If you were using a disposable razor this morning to shave, more than likely the razor blade cartridge that you used was made on an Mpac machine. Our machines handle wet contact lenses being picked straight off the autoclave and put into their packaging. Our machines load ice cream bars into cartons at incredible speeds, put tissues into boxes. Further down the production line at a factory, our machines convey and stack the large cardboard corrugated cases, for example, of snack food, onto pallets for distribution. And right the way across a factory production line, our vision systems are actively managing the quality and production output of lines for our customers. So that's the kind of stuff that we do today, and the group is completely different, really, very different from this time last year as a result of those acquisitions. Next chart, please. One thing that hasn't changed is the way in which we win and retain customers. So we start in consultation with customers, looking at the design of their packaging, the design of their products, and the way that that then feeds into the design of the assembly process on the production line. It's a very small part of our business today, contributes a negligible amount really to our revenue and profit, but of course it's key in the way that we win and retain customers. The bulk of our business is around the design, build and installation of equipment into our customers' factories, and then of course monitoring and optimizing, providing service support throughout the life of those equipments. Next chart, please. Another piece that hasn't changed is the opportunity for growth. We operate in attractive markets, attractive in four ways. Firstly, they are very large. Every year, around $50 billion worth of equipment is bought by customers like ours somewhere in the world. Our market share of our addressable market is hovering around 3% at the end of last year. So we've got a significant opportunity to grow our business by growing our share of that market. And we compete with a very wide range of competitors. Some companies that are much smaller than Mpac, operating perhaps with just a specialist type of machinery in a single part of a production line or in a particular region within the world, right up to some organizations much larger than Mpac, several billion revenue, who might offer multiple pieces of equipment across a flow line in multiple regions and perhaps multiple sectors as well. And those larger businesses have grown to the scale that they are by buying some of the smaller businesses along the way. And of course, that's what we've been doing over the last few years as well. So that competition fragmentation gives us opportunities as well. The fourth way in which our markets are attractive is that despite those large companies that we compete with, we can still compete and win business against them with our customers every day, because our customers make decisions not just on the basis of the price of a product, but actually the technology and the performance of the product that's being offered. Reliability and efficiency is absolutely key to our customers, and to the extent that our teams are able to find elegant ways to design new production lines in the future, we're able to compete and win. And of course, that means that the people in our business are key. And I know every chief exec says that, but in our case, it is really true. Our people, the ability of our people to work with our customers and find solutions to those technical problems is absolutely what sets us apart. And our ability to retain those key people presents a barrier to entry against our competitors and new entrants into the market. And of course, I guess the bottom line, the world is becoming more automated. The increase in the cost of labour, competition for people is driving a need for more and more automation in the world. We're seeing that particularly right now as we look at some of the factors that are affecting macroeconomics around the world. And we'll talk a bit more about that during the course of this conversation. Next chart, please. As an investment proposition, there are four things I'd really like to highlight. The first is in the top left-hand corner of this chart we've talked about already, the growth opportunity that the scale of our market presents. Quality of earnings, I think, is really important to talk about though as well. We started this year with a substantial order book that gives us good order coverage over the revenues for this year. And if you combine that with a short cycle business that we see through our service organisation, which we will see coming on during the course of this year, it gives us a really good visibility over the revenues for 2025. And that's true of every year in the past as well. So high quality of earnings. We've already talked about the high barriers to entry that our people bring to our organisation. You can see the technical hours in 2024 up significantly from 2023. Some of that through the acquisition and the onboarding of new staff during the year as well. And lastly, we think of ourselves as a capital light business. So we're very pleased with the operating profit performance of the group, up to 9.8% in 2024. But really, when you look at what our return on capital employed is capable of, 19.7% in 2025, that's where we're projecting 2025. Of course, it'll be a bit lower at the end of 2024 with the capital raise for those acquisitions at the very tail end of the year. But nevertheless, 20% ROCE is a good number in anyone's book. Next chart, please. Over the last few years, we've been really focused on broadening out our key account businesses, our customers. And last year, I'm really proud of the way the team have performed. We won original equipment orders with 73 different customers. By value, 37% of our original equipment orders were won with new customers to Mpac that we hadn't worked with before. And of those, 6 of our new account customers have the scale and breadth in their businesses to place orders with us, not just once, but we hope many, many years to come, and perhaps in a single year, more than just one factory order as well. Last year, just those 6 new strategic accounts contributed £8 million of orders to the group performance. So it really does make a significant difference. We've been working on that, not because we had a customer concentration issue. In fact, we don't. No one customer makes up more than 10% of our group, but because it's a really good way of growing top line revenue and driving the profitability of the performance in a repeatable way for the future. An example of that, I think, is probably best given from the very bottom example on this chart, Johnson & Johnson. We've been working with Johnson & Johnson for many, many years now, and they've been a customer of our Langen business, providing cartoning machines to Johnson & Johnson for decades. For the first time last year, we took an order with Johnson & Johnson into our Lambert business, and that cross-sell between 2 existing businesses within the group really tells you something about why we think this is important, and of course plays into the acquisitions that we made in the course of last year too. Next chart, please. So I'd like to talk a little bit about the acquisitions. CSi Palletising was a significant acquisition for Mpac for a few reasons, really. Firstly, the technology fit between the secondary packaging machines and the end-of-line palletising machines and conveying that CSi offer to their customers was a really good fit with the rest of the Mpac Group companies. Secondly, the scale. CSi today employs 450 people, and that represents about 40% of the total headcount of the Mpac Group today. So it's a significant acquisition for Mpac, changes the scale of our business. It also changes the customer base that we can sell into. I think I've already mentioned to you CSi's significant sales in South America, across Europe and Central America. The customer base lines up really, really well with the other Mpac Group companies and gives us a fantastic opportunity to cross-sell between the businesses in the Mpac Group and support customers in a more meaningful way. The operating footprint that CSi bring to the group is also really exciting. Headquartered in the Netherlands with manufacturing and assembly facilities in Romania, sales and service offices in Mexico, and sales support across a very wide range of countries across the world. Really exciting opportunities for Mpac in the future. And lastly, I really want to highlight the CSi team's ability to deliver strategy and strategic change in their business. It's absolutely outstanding. Last year, in 2024, the team at CSi were very focused on improving their customer concentration. If you go back to previous years, they've done a fantastic job building their business to a point where their first customer 1, was placing multiple orders with them many, many years on the trot, and actually had grown to 64% of their business. So only 36% of their project order book that year came from non-customer 1. During 2024, the team at CSi did a fantastic job winning business with a whole wide range of other customers and drove that non-customer 1 concentration from 36% to 77% last year. And they're on track already in 2025 to repeat that. So a fantastic performance from the team there. Next chart, please. Let's come on to talk about another fantastic business, BCA, Boston Conveyors and Automation, obviously based in Boston, Massachusetts, in the US. The capability of the BCA team to provide equipment that handles raw naked food products in pick and place machines, in conveying, sanitary conveying, washdown conveying for food and beverage customers is absolutely incredible. Obviously, located inside the US with machining and assembly capability. We're really excited about the ability of the BCA team to attract outstanding engineers and operators, new people joining the Mpac Group from the Boston area, close to MIT. It's a fantastic place to be recruiting. And the people in BCA are absolutely outstanding too. Very, very strong customer relationships. Last year, just after the acquisition was completed in September, by December, the team had factory acceptance tested the largest project that the BCA business has ever delivered in its own facilities, demonstrating a new lasagna line, the performance of that line. And then just in the last few weeks this year, in April, the team have site acceptance tested that same machine, now installed, commissioned and up and running, producing revenue for its customer in a lasagna factory in the US. It's an incredible achievement by the team, really, really proud of what they've achieved. And for us looking ahead, it demonstrates the kind of multi-million-dollar line capability that BCA can achieve in their markets. So wonderful achievement. Next chart, please. I'm going to hand over to Will now, and I'll take you through a broad sweep of how we performed in 2024, and then we'll look ahead to 2025. Will.
Okay, thank you, Adam. So as Adam's already said, a transformational year for Mpac, and I'm going to run through what we think is a really strong set of financial results and KPIs for the year. So if I start with order intake, up a modest 1% to 119.7 million, but for some context here, the prior year order intake was up 43%. So a year of consolidating what was really strong prior growth. And we were pleased with being able to consolidate on that strong prior year and show some further development. To break that down a little bit, give a bit more context, EMEA performed really well in 2024. It was up 28% to 56 million. So a very strong performance in EMEA last year. On to revenue, we're reporting 7.2% growth in revenue to 122 million. Our original equipment business, side of business, was the main driver to that strong revenue growth last year. And if probably take this opportunity to draw your eye down to the graph at the bottom there, which shows revenue development over the last 5 years, where we're pleased to be able to show continued steady growth in revenue over that longer term. In respect of order intake, obviously order intake in the order book at the end of 24 now includes the order book from the acquired businesses, CSi and BCA. So with those overlaid into the order book from the pre-acquisition businesses, we're showing 118.5 million. That's 63% up on the prior year. The important point for us is that gives us 55% coverage over 2025 forecast revenue. And that's really in the sweet spot of where we'd like to be. Around 55% gives us a good level of coverage. When you overlay the short cycle recurring service revenue over the course of 2025, it gives us a good position where lead times are not too long, but we've got a high degree of certainty over the revenue for the year. Moving on to profit margins. Sorry, Hannah, not next slide, just profit margins. So gross profit margin, a strong year, up 2.4 percentage points to 30.1%. So again, it's original equipment performance has been really driving that, and especially in half two. And again, the bar chart at the bottom of the page there shows a strong half two 24 gross margin up to 33%. And again, a trend of continuing improvements in gross margins over the recent years. How have we delivered that? What's been the driver to that? It's original equipment, but it comes down to the basics of good project execution. So delivering projects on time, on budget, at the cost that we expect to, driving that profit margin. So we're really pleased that we are able to report that strong development. So the increase in margin and the increase in revenue clearly drops through to good underlying operating profit and PBT. So again, bar chart on the bottom right-hand side, we're reporting underlying operating profit in the year 12 million. That's a the largest profit that we've reported on an underlying operating profit basis in the history of Mpac. It's 9.8% for the year, so we're making really good progress towards our stated strategic intent to hit 10% operating returns. After the costs of financing, the underlying PBT, again, really strong year, 10.6 million, up 49% from 7.1 in the previous year. And that equates to an underlying EPS of 35.2p, up 35%. Touching on working capital, and then I'll come to the last part on this slide. So working capital is 0.4, fairly balanced position in the year. Working capital down from 13.2 million in the prior year. The main driver to that has been the additional deposits and milestone payments within our contract liabilities associated with that larger order book. That's helped to reduce the working capital position. Net debt at the end of the year was 37.5 million. That's from a net cash position the previous year, clearly related to the acquisition of the two businesses in the year, partially funded by debt. If we can move on, Hannah, please. So on this chart, I'll give an overview of the transition on underlying PBT in the year from the prior year 7.1 million to 10.6 for the full year. So the first part of the driver to that increased profitability is the revenue increase, 3.6 million attributed to revenue on a consistent margin basis, and the margin increase on that additional revenue, that's a higher 2.4 percentage points, equates to the 2.9 million. The really pleasing part here is that we've been able to demonstrate again that we can grow revenue at the same time as growing margins. We're not chasing revenue at the expense of margins. We've been able to deliver both, and that's really contributes towards that strong performance in the year. In terms of revenue, you can see on the right-hand side the source of revenue from our segmental reporting between original equipment and service. Original equipment continues to show that steady progress. Service was down slightly on the prior year, but you'll note that the prior year, 2023, was really a breakout year for service. So we're pleased to be able to say we've consolidated that really strong performance in the prior year, down slightly, but the trend over that 5-year period is still very progressive. In terms of the cost changes in the year compared to the prior year, administrative costs up slightly. Sales, marketing, and distribution costs are up by 1.7 million. An element of that are the distribution costs, which are variable, so attributed to the higher revenue. And then there's additional sales and marketing costs, partially attributed to the two acquired businesses and some controlled costs expansion from the existing businesses, pre-acquisition businesses. And then financing expenses related to the additional debt to acquire the two businesses. In terms of non-underlying items, there's a table on the right-hand side which reconciles underlying PBT to statutory PBT. 3.5 million of acquisition costs in 2024. There were no restructuring costs in 2024, so those costs are wholly attributed to the two acquisitions in the year. There's pension-related items, amortization of acquired intangibles, and then there are closeout costs relating to the Freya contract, which we're now completed in the year and have no balances left on either the balance sheet or the order book. We can move on, please, Hannah. So here we show the balance sheet for 24 versus 23, and obviously we're a completely different group now with the two acquisitions in the year, especially the acquisition of CSi, which is a material acquisition for us. So the comparable balance sheets are a little bit more difficult to explain. So I'll go through the individual positions there and explain the movements. If we start with non-current assets, so having acquired CSi and BCA, there's additional goodwill, acquired intangibles, and an increase in the IAS 19 pension asset, and that explains the increase over the prior year. Inventories are up, but actually inventory turn is down, so that's a position we're happy with and is well under control. Trade and other receivables and trade and other payables, they're the other two larger movements. So just explain what's included within there. Within trade and other receivables, the majority of the balance in there are either trade debtors. We have a very, very clean trade receivables position. We operate with blue chip customers and minimal overdue debts. And then there are contract assets, and the contract assets associated with unbilled revenue. So that's projects as they progress before they hit billing milestones, and then materials purchased in advance at that stage of completion. So it's all attributed to contract execution, original equipment execution. For contract liabilities within trade and other payables, the positions there are deposits, which I spoke previously about being the driver to the reduced level of working capital at the end of the year. And then contracts trading in advance of materials purchase. So they're the main movements in that respect. Can we move on to another slide, please, Hannah? So the cash bridge. So this is here to show the transition in gross cash at the end of 23 to gross cash at the end of 24. So that transition from 11 million to the reported 18 million. And obviously in a year such as 2024 for Mpac, the vast majority of the changes in the year are going to be attributed to the two acquisitions. But if I start from the left-hand side, so EBITDA, we've covered that. It was a strong EBITDA in the year, driven by higher volumes, better margins, good cost control. The movement in working capital was an increase in working capital of 7.4 million. That's different to the overall working capital position of 0.4 at the end of the year, because this is the movement in the year, excluding the take on of the acquired businesses' balance sheets. And then we have proceeds from borrowings of 38.5 million, the net funds from the equity raise of 28.4, and then the cash on acquisition of the acquired businesses was 54.8 million. 2.3 million was paid as our ongoing contributions to the pension scheme, the defined benefit pension scheme in the UK and in the US. And we don't have a slide on that, but it's probably worth touching on that for a moment because Adam mentioned it previously. We completed on the June 2024 valuation and communicated in January of this year that the scheme is now in surplus. And it's quite a healthy surplus. It's funded on an actuarial basis at 108%. So we are now working with the trustees on the next stage, and there's an active process to conclude on the pension scheme and hopefully reach the final goal of decoupling and de-risking association of the pension scheme from the company. I'm sure there'll be more news on that at some point in the future. Capital additions in the year of 4.7 million. This is associated mainly with new product development, and there were two flagship projects that were completed in 2024. Adam will touch on those later. They were new products which we launched to the market. Overall, as a group, last year we spent 3.8% of revenue on innovation and R&D. That's broadly consistent with the prior year. And we have an objective within our business to continue to invest to keep vitality in our product range and bring new products to our customers. And then finally, we have lease payments and tax acquisition costs, really the main item in there, and interest, which takes us to the closing gross cash position of 18.2 million. Finally, I'll touch on the borrowing facility. So to support the acquisition of the businesses last year, we entered into a new committed borrowing facility that lasts as a commitment until September 27, and it leaves us with sufficient capital to continue to invest in the business and continue the positive trajectory that we've been able to report on this year. So I'll pass back to Adam.
Thank you, Will. So I'd like to spend a few minutes talking about ambition and strategy. And as with anything in Mpac, we're going to start that by talking about people. For many, many years now, the Mpac Group has operated around 5 pillars of our strategy: going for growth, operational excellence, outstanding customer service, innovation, and people. And the previous leadership structure wasn't aligned with that, and now it is. That change has brought Mike Brown into a new role as Chief Commercial Officer, leading our original equipment marketing and sales. Mike has been with the Mpac Group for quite a while now, is a very, very seasoned marketing and sales campaigner. And alongside him, David Taylor joins the team, the leadership team now as Group Services Director. David was previously the Managing Director of the Lambert business based in the UK, and he now steps up to lead the global service teams across the Mpac Group. Steve Blair joins Mpac as Chief Operating Officer, a new role, and Steve heads up the team of managing directors across the Mpac Groups. He has a strong background leading global businesses, organizations of several thousand people, and really sets the benchmark for Mpac's scale and ambition of where we're going in the future. So next chart, please, and we'll talk a bit about scale and ambition. So the previous 5-year plan we set out a couple of years ago was to double the group over a 5-year period. With the acquisitions last year, we're on track now to do that in 3 years, not 5. So it's time for a new 5-year plan. And the new 5-year plan will sound very much like the old 5-year plan. We're going to double the group over 5 years, but it's now from an enlarged baseline. So 5 years from 2025 to 2030, doubling over that period and achieving better than 10% operating returns. We're going to do that by driving our organic growth, double-digit organic growth every year. We're going to be looking at commercial synergies from the businesses that we have already acquired. And of course, in due course, we will look to continue to expand the group through further acquisitions to offer an increasingly full line to our customers. I must stress that right now in 2025, our focus is on driving the businesses that we've already acquired in 2024, integrating those and seeing the synergies from those investments last year. Next chart, please. Let's just touch a little bit on progress on group strategy in the organic part of our business in 2024. I think undergoing for growth, we've already talked a little bit about the broadening of our customer base, the driving of the pipeline of new prospects has come up. If you think through the financial summary from Will. So I'll move on to talk about outstanding customer service. I'm going to pick out just one item to focus on here. The team have made really good progress in moving our spare parts fulfillment from Canada into the US. 80% of our parts are now already complete in that move from Canada to the US, and we're on track to complete that in the course of 2025. So significant change for the team there, very important for the US market. If I look at innovation, I'm really pleased with the product launches that the team have achieved last year, new products entering the market. To talk about just one of them, the Ostro is our new mid-range cartoner. We've already taken 4 orders for that machine since its launch, which is a really fast uptake in the market. Perhaps most importantly, one of those new orders came from a new customer to Mpac on one of the previous charts. You might be able to pick them out. They are a customer who has chosen the Ostro for one of their bakery sector products. And it demonstrates how important innovation is to winning new customers. You know, the reason that customer selected the Ostro is it solves a problem that they needed solved, and they couldn't find any machine from anybody else in the world that could do it, and Mpac could. So that was the reason that we were able to successfully get into that new customer. You might have seen on social media last week, on Friday, that we also launched a new range of pizza cartoning machines, frozen pizza cartoning machines, the Brisa Pizza, the Maestro Pizza, and the Maestro Pizza XL. So we're continuing to innovate, and there's more to come in 2025. We touched quite a bit on people, so I'm going to move on to operational excellence in the interest of time. I really want to emphasize 2.5 percentage points improvement in gross margin is really hard to do, and the team have done a great job driving that. Consistent revenue growth over 5 years, also hard to do, and 49% increase in operating profit. If you go back to 2022, £4 million of operating profit. In 2023, £8 million of operating profit, and in 2024, £12 million of operating profit. 4, 8, 12 in 3 consecutive years. That improvement in project execution margins is absolutely outstanding, and well done to the teams that have made that possible. Next chart, please. So I'm going to come on to summarize 2024. We'll talk a bit about the 25 outlook, and then Will and I will pause to take questions from you. 2024 then, what are the highlights? Well, for me, three things. It was a transformational year. It was transformational in terms of scale. It was transformational for the group in terms of performance. And it was transformational in the leadership team that we take forwards into 2025. And the 2025 outlook, we started the year, as Will said, with a record opening order book, the strongest order book that we've ever had in the group. Quarter one order intake has been broadly in line with expectations. With that change of regional splits with CSi coming into the organisation, we've seen strong performance in the rest of the world, perhaps a little bit slower inside the US for reasons that I'm sure are apparent to all of you. And we've got a really strong pipeline of prospects going into quarter two of this year and looking ahead to the balance of the year. So I'm encouraged by the outlook on order intake. We are closely monitoring the global economic position, but at this time, we are on track to achieve the full year expectations in 2025 in line with market guidance.
How do you intend to achieve falls in debt levels into 25 and 26 as forecast?
Yeah, Will, can I turn to you?
Yeah, sure. I'll pick that up, Adam. So clearly we're modelling, we're forecasting on a high degree of granularity our financial performance over 25 and 26. We've got a great order book going into the year. We've demonstrated the ability to be able to deliver projects at high margin. We've got a good margin recurring service business. All of that will drive cash profits and control of working capital, especially in the second half of 25 and into 26. And they're the main drivers: control of working capital, good cash profit generation delivered from the opening order book and the healthy and vibrant pipeline that we have for new opportunities in the year. So our modelling supports the deleveraging and reduction in debt, and we're confident we're standing behind that position.
Thank you. How many of your strategic key accounts currently take more than the one Mpac service?
Oh, that's a great question. I'll pick that one up, Will. I want to give you an example. Right, so we completed the acquisition of BCA in September, and they completed the acquisition of CSi in December last year. So it's early days, but I'm really pleased that we've already won an order in 2025 that combines a pre-acquisition business working with an acquired business on the same contract. And actually, it was that way around. It was an opportunity that we were working on with a pre-acquisition business, and now it's both a pre and a post-acquisition business combining their skills to deliver. So this kind of ability to support across the group and cross-sell is already very significant. What we've done as a team is to look at every customer opportunity that we've secured over the last 5 years, both in the pre-acquisition businesses and in the acquired businesses, and to look at opportunities where we've sold into the same customer or haven't. The sales team have now been through that list to identify target customers where we think there are cross-sell opportunities that could add value to those customers. They've written a short list of 20 that we're focusing on. I don't think we'll achieve all 20 in the first year. Of course we won't, but we're very clear on where we think the opportunities for customers are, and we're going after that list of 20 in a really coordinated way. And you can see from the performance so far that it is working. So I'm really excited about the opportunity to. We're describing it as turning customers stripy. We've got a chart of sales by business into customers, and the stripier it gets, the more the cross-sell is working.
Like that analogy. Will, one for you. Can you give us a bit more detail on the cost of your new borrowings?
The forecast for this year, cost of borrowings, approximately £3 million, reducing significantly in 2026.
Okay, thank you. Is the clean energy space still of interest to Mpac?
The short answer is yes. We continue to work in clean energy. We have contracts right now today with a number of clean energy and battery businesses that we're reporting as part of the other category. So we're focused on food and beverage, on healthcare and other. If you go back in time, in the past, clean energy was a small part of the group, but with some real potential. With the acquisitions that we've made last year, clean energy is now a very small part of the group. And I think my view on what's happening in the sort of wider economic political climate is, I think, focus on development in the clean energy space is perhaps going a little slower than we might have thought a year ago. Our reflection on that is we still think it's an opportunity for the future, but it's a small part of the group, and we're not going to break it out and spend investor time focused on it in these conversations going forwards. But we are going to continue to support customers in that space.
Well, perhaps then to finish with a last question before we draw a line under it. Why did so much of the close down costs of Freya fall on Mpac?
Yeah, look, Freya was a real story last year, wasn't it? We in the middle of the year, we celebrated with the Freya team the success of the Mpac and Freya project team working on the first fully automated production cell off their battery assembly line in Norway. We took photographs and bought pizzas and big social media splashes. We were very pleased with the progress. Freya have gone in a different direction in the second half of last year. We understand the reasons for that, and the process of closing out that contract with Freya wasn't easy for us. We've ended the year with a completely clean position. That involved us taking impairments of investments that we've made back in 2022. So those are in our 2024 numbers. You can see those there. And also demobilizing quite a substantial project team that we had working on it in the run up to that mid-year activity. Those costs fall with Mpac. The costs of perform work under the contract itself lay with Freya, and were part of the settlement that brought us to that final position. So, I think we reached a very sensible and fair position with Freya, and we've got a clean balance sheet, a clean order book going forwards with no exposure remaining.
Great. Adam, as you say, 20% return on capital is far from shabby, but we are keen that you raise it further. What do you think might be achievable in the medium term?
Yeah, well, I think you've got me on record last year talking about mid-20s ROCE being possible for the group, and I think this was a pre-acquisition statement, and of course it goes backwards a bit as you raise equity to complete acquisitions. So the end of last year, perhaps a little bit behind, but I certainly still see a route for us to get to mid-20s ROCE in the future, and that is absolutely our objective.
Excellent, thank you. Do you see Mpac as a potential beneficiary of US tariffs from reshoring prospects, given the geographic nature of the business?
Yes. I'm learning from Will to answer questions succinctly. Let me be a bit.
I like it.
Let me expand on that a little bit. One of the things that we think a lot about is the long-term effect of what Trump is trying to achieve in the US, and his stated objective is to drive an increase in domestic production within the US. Our FMCG customers are responding to that, and we already have examples of customers who are reshoring, who are building new factories in the US to replace factories that they used outside of the US previously. So it is already happening. If customers build factories inside the US, of course, that is great news for companies like ours. Anyone who's involved in the business of building factories is going to benefit from that. If you're building a factory in the US rather than anywhere else in the world, the relatively high cost of labor in the US means you need more automation to make the business case to get the return on investment. And that's sort of doubly good news if you're in the business of automating new factory production, and that is what we do. And I guess the icing on the cake would be if you happen to have facilities inside the US yourselves from which to support those customers on that factory automation activity. And we do. We have 2 facilities inside the US today, and we're very pleased with the timing of the BCA acquisition, giving us that footprint in Boston. So yeah, I absolutely see an opportunity for Mpac over the mid to long term as Trump's stated policy objectives start to take effect. We are absolutely clear in our own minds that the short-term impact of uncertainty in the US market is slower customer decision making. So there's a balance of short-term impact and long-term impact, and we have to keep both in mind.
Thank you. Acquisitions, obviously, 3 key ones have materially boosted your top line. How important do you think M&A will continue to be in realizing growth ambitions?
Yeah, well, look, over the long run, I think acquisitions are really important to the Mpac Group. That's why they feature so highly in our strategy. The strategy that we set for the group was to continue to broaden out the kind of full line offering to customers, so that if a customer wants to build a factory in the future, they put the walls up. Mpac machines might one day complete the entire production facility for inside those new walls. That's where we'd like to get to, and that remains the objective. We were very clear that it's a technology-based acquisition strategy, therefore, what it is not is a strategy around broadening out our kind of operating footprint into countries that we don't know how to operate in. We weren't looking to accidentally acquire a business with footprints in, I don't know, Brazil or China or something, an operating business that we wouldn't know how to operate today. And it's not about moving into new sectors. We've got a huge market share opportunity in food and beverage and healthcare, without straying accidentally through acquisition into sectors that we don't know how to support customers in today. So, we're really clear about what it is and what it isn't. The other piece I'd like to really emphasize is that, we made a substantial change last year. And completing the integration of those businesses and really driving the synergies from those businesses takes time. And the entire focus of our leadership team is on achieving that in 2025. We're very, very clear. We don't want to run faster than we should be in our acquisitions. Our immediate focus in 2025 is integrating and driving the synergies from the businesses that we've acquired in 2024. In the background, we'll continue to work with the owners of other businesses to keep the pipeline warm. And one day in the future, when we're ready, we'll be ready to make those future acquisitions. But 2025, it's a focus year.
Thank you. A couple of questions here, actually, on the same theme, which is around the order intake for the business, and specifically on the book-to-bill figure of 0.41 that was in this week's results. Could you give investors a little bit more of an understanding of that number and any concerns or opportunities that come from it?
Yeah, Will, shall I hand over to you?
Sure. Okay. So order intake profile typically for Mpac, slightly seasonal. We usually see a slow Q1 in any year. Customers go through a cycle to consume their investments budgets, typically annually. So a slow Q1 is normal in our profile, and I think that's where we've been started this year. If you break that down by region, EMEA and the rest of the world has been reasonably strong. We have seen a downturn or slower decision making from customers in the US. But the real significant periods for order intake for Mpac ramp up during Q2 and especially in Q3 and Q4. So as at today, we are broadly on track to where we'd expect to be for order intake year to date. And more importantly, our pipeline of new opportunities remains vibrant and strong. Now, there's enough in there to give us confidence on order intake for the year and revenue and continuing to develop our order book. But we are clearly in a period of uncertainty, specifically in the US market. So, we are working hard with customers to move the opportunity pipeline through down the funnel to convert to orders. And at the moment, the metrics will support our guidance and our ability to do that this year. And directly to the question, the position of book and bill at the end of Q1 does not give us concern. It's where we'd expect to be.
Super, thank you. Do the economics of CSI's production facility in Romania apply just to CSI, or are there wider potential group applications or benefits?
Yeah, it's a great question. We have already started right now in May the assembly of our first non-CSI product in the CSI facilities in Romania. It's early days, and we're not about to see a sort of material change in the outlook, the guidance that was produced earlier this week for 2025. But it's really important, I think, that we get going with those activities and see what's possible in Romania, and we have already started. So I think the short answer is yes.
Another theme in a couple of questions, I guess leading on perhaps from that order book, is how exposed do you feel with an unpredictable Trump marauding around in the White House, and other macro headwinds? How exposed do you feel as you were 5 months into this year?
Yeah. Well, Will's talked a little bit about the balance of order intake so far this year. And, the US has been slow, and the rest of the world has been broadly in line with where we thought we'd be. So there's definitely a short-term impact here. I spent quite a lot of time in the US talking with customers there, and the most important theme that comes out is one of concern about uncertainty. And actually, it's not a tariff conversation so much when I speak to customers, as a conversation about concerns about moving into a recession in the US, and perhaps even a recession that affects countries outside the US as well. When I think about what that means for Mpac, I think it's really important we start with the markets that we operate in. The healthcare market tends not to be impacted significantly by recession, and neither by boom either. If you were buying an asthma inhaler yesterday, you're likely to buy an asthma inhaler today, regardless of what's happening in the economy. So our healthcare market really is a defensive market. It's resilient and robust, and we expect that to persist during a downturn. On the food and beverage market, we do see changes. If you were planning to build a champagne bottling factory tomorrow, maybe you revisit that decision. If you're thinking about whether to invest in a new lasagna or frozen pizza factory tomorrow, that starts to look quite attractive during a recession. We see consumer focus shift towards convenience and value-based products, and our business is absolutely about supporting those kinds of food and beverage production lines just as much as it is high-end champagne bottling lines as well. So food and beverage for us is a defensive market as well. The change from one to another, that transition takes time, and that, I think, is part of the reason we've seen a slowdown in the first quarter of this year in the US. But entering a recession in the long run, I think we're well positioned to work through that.
That's really full answer. Thank you. During the COVID supply chain period, you experienced shortages of key components. Do you envisage any similar disruptions arising from the current tariff situation?
No. No, the microchip shortages that affected all sorts of products back in just after the COVID crisis is not really a feature of today. We've seen price rises from some of our suppliers already in response to tariffs. In fact, we've seen them in response to the first round of tariffs that were then rolled back by Trump. So that's a feature of the market, I'm afraid. The good news for Mpac is that we are affected in the same way as all of our competitors. So it doesn't affect us in terms of advantage or disadvantage. For example, many of the price rises that we've seen have been global price rises, not country-specific price rises in response to tariffs. So look, we're not being complacent about it. We're monitoring it very closely, but that isn't the biggest concern that I have around tariffs. It's around how the market reacts to uncertainty, and when we shift from that slowdown in the US into what I suspect will be an uptick to come.
Thanks. Perhaps one for you, Will. Volatility in bond markets and these wider market movements, will it impact progress in pension provisions?
Thankfully not. We've got 100% of our exposure hedged. So the position that we've got to and achieved with funding level is now secure, and assuming the hedge works, it's protected against volatility to discount rates.
Thank you. And given the 30% gross margin achieved this year, can we take this as a benchmark going forward?
Shall I carry on?
Absolutely.
Well, you probably won't be surprised that we set targets internally, which are a stretch for our businesses to achieve. But the second half of last year, we achieved more than 30% gross margin. So as a management team, we should be looking to kick on and continue to improve. And some of that scale and volume based, but it's also about doing our work well and progressing projects and execution projects to plan. So yes.
And the last question here, do your contracts allow for you to pass price rises through?
We sell to our customers on a fixed price. At the point we enter into a contract, we're committed at that price. So the short answer is no, but a bit of context here. We are pricing and costing our projects, the dynamic costing model. So we are securing prices from our suppliers at the point when we are agreeing prices to our customers. So we're exposed in a short window between receiving an order from the customer and then fixing the prices with our supply chain, but the window is short, and broadly speaking, we're able to capture any price changes and inflationary cost pressures into the price that we quote to our customers.
Well, super. That is it for the questions today. So just leaves me to thank our listeners for joining us, and to you both for some really full and helpful answers today. And we look forward to an update in another 6 months' time.
Very good. Thank you, Hannah.